Hi everyone, in this video we are again continuing with our FM Pre-December 2025 mock exam. Now with this video we are continuing section B, the second case study is what we'll discuss over here. So from what I can see at an overview, I can see that this belongs to the business valuation area of our syllabus, as the very first question is asking me to find out the value of the company using the PE ratio method. The name of the question is Gonzola company. So PE ratio method is what I have to use to find out the value of the whole company as part of my first requirement. So let's have a look at all of the information that has been provided to us. So the question is telling me that Gonzola company is a listed company with a cost of equity of 12%, which plans to achieve a dividend growth of 5% per year for the foreseeable future. Gonzola company operates in an industry with an average PE ratio of 12.5 times. The ordinary shares of the company have a nominal value of $0.5 per share. The extracts from the financial statements of the company are as follows. So they have given me some information about the P&L as well as the balance sheet of the company. The long-term borrowings consist of loan notes paying a 7% interest per year, which are redeemable in 7 years' time at a 5% premium to their nominal value of $100 per loan note. The before tax cost of debt of Gonzola company is 5% per year, and the after tax cost of debt is given to us as 4% per year. Now let's first find out the value of the whole company using the PE ratio method. Now I have learned when I was studying my concepts that if I want to find out the value of the company, value of company will be equal to the PAT minus the preference dividend figure multiplied by the PE ratio. So I know already the PE ratio is given to me in the question as 12.5 times. I just need to find out how much is my PAT after the preference dividend. So I start off with operating profit, interest expenses deducted. With that, I come to my profit before tax. After I pay taxes, I'm left with a profit for the year of $264 million, from which only ordinary dividends are paid. And within the balance sheet structure that's provided to me, I can also see that there's no mention of any sort of preference shares. So I'll assume that this G company does not have any of the preference shares in its capital. So the PAT is the exact figure which I will take for my number, which I will multiply with the PE ratio. So here I open my on-screen calculator. 12.5 is the average PE ratio that has been provided to me over here. So I take 12.5 and I multiply that by my profit for the year, which is 264. Hit enter, and $3,300 million is the value of the whole company using the PE ratio method. So this was the first question, very easy. Let's now move to the second one. What is the value of one share in Gonzola company using the dividend valuation model? So for this, you people are also given the formula on the exam formula sheet. So if you want to use the dividend valuation model using the growth formula, this is how you can find out the P0. P0 is equal to D0 into 1 plus G divided by the cost of equity minus G. So you're given with the growth rate in the very first line with 5%, and you're also given with the cost of equity of 12%. But what you do not know directly over here in the question, it's not told by you that how much is the dividend per share that the company is offering. I know that the total dividend given to all of the shareholders is $160 million. But if I want to find out the dividend per share, because I need to find out the value of one share, I need to divide the total dividend with the total number of shares that are there in the company. So to find out the number of shares, I know that the formula is that you take the total nominal value of the capital and you divide it by the nominal value of one share. So it is given to me that the total value of the capital is $100 million with a nominal value of $0.5 per share. So I divide it with 0.5. That gives me $200 million of 200 million number of shares that exist in the company. So that means if 160 million was the total dividend given and 200 million is the number of shares, that means a dividend of $0.8 per share was offered to each shareholder. Now this is D0. As per the formula sheet, I'm supposed to take D0 into 1 plus G divided by the cost of equity minus G. So this is my D0 into 1 plus the growth rate is given to me as 5%. So what you can do is take 0.8 into 1.05. And then for your denominator, you're supposed to take the difference between the cost of equity and the growth rate. Cost of equity was given to you as 12% over here in the question. 12% over here is the cost of equity, 5% is the growth rate. So the difference is going to be 7%, which is 0.07. So you hit enter and you find out that one share is going to be worth $12 in Gonzola company using the dividend valuation model. Now proceeding towards question number 23, we're supposed to find out the market value of the loan notes of Gonzola company. With respect to the loan notes, the last paragraph gave me the information. It told me that they are paying a 7% interest per year, which are redeemable in 7 years time at a 5% premium to their nominal value. The before tax cost is given and the after tax cost is given. Now I know when I want to find out the market value of the loan notes, I have to discount all of the cash flows to their present value using the investor's required rate of return. Now here we are talking about the market value. In the market, it is the investors who trade in these loan notes. So that means we are considering the perspective of the investors. Now it is not the investors who get any tax benefits. The company gets tax benefits because of the presence of debt in their capital structure. Because of interest on that debt, they have to pay lesser taxes. So the after tax cost is something which is relevant from the perspective of the company. But when I'm talking about market value, I'm talking about investors. I'm talking from their perspective. So their perspective means I will consider 5% as the cost of capital, which I will use to discount all the cash flows which are there with this loan note. So what I do is I open the formula sheet. 5% is the cost given. Yes, 5% is the pre-tax cost that is given to me. Firstly, the interest is going to be received over a period of 7 years. Same amount of money, 7% is the interest rate also. For 7 years, I will keep on receiving $7. So it's an annuity at a rate of 5%. If you keep receiving money for 7 years, 5.786 is the factor that we are supposed to use. So 5.786 is the factor which I will multiply with 7. This is the interest part's PV. Now I also have to consider what will be the present value of the repayment that I will be getting after 7 years. So it told me that after 7 years are over, I am going to get a 5% premium on the redemption. That means if the nominal value is $100, the premium will be 5%. That means at the end, I'm going to receive $105. So that means now this is a one-off payment that I will receive. So what I want to do is I want to add 105 to it. 5.786 into 7 plus I want to take 105 with its present value factor. The present value factor I will pick up from here 5% I took the figure for 5 years. It should have been 7 years. Yes, this one is correct. For this also, we will take the 7th year figure, which is 0.711. So I'll multiply this with 0.711, close the brackets, hit enter, and this is what is going to give me my final answer of the value of this particular loan note. So they are asking me the total market value of the loan notes. Here I have calculated the value of one loan note. Now if I want to find it out for all of the loan notes, I just need to multiply it with the number of loan notes. How can I get to know that what is the number of loan notes? I can note down the per loan note value over here. Per loan note, if I consider, it's roughly 115.16 in 2 decimal places. This is the value per loan note. Now let's work to find out how much are the number of loan notes. They are telling me that my long-term borrowings are $300 million in worth in total. So that means $300 million is the total nominal value one loan note is worth 100. So that means I have $3 million of loan notes, 3 million number of loan notes in issue. So if one loan note is worth 115.16, then 3 million are going to be worth 3 into 115.16. So if you take the product, this is what you get to. 345.5 roughly million dollars is the total market value of the loan notes that Gonzola company has in issue. Moving towards the second last question basis this case study, which of the following statements about noise traders is or are correct? The first statement says that they generally underreact to good news and bad news. Noise traders are the people who do not do any sort of analysis and they just keep on overreacting to the news. This statement says they underreact. That means this statement is incorrect. Second is they make rational decisions on the basis of fundamental data. They never do any research. They simply overreact to the news happening around them. Good news or bad news, they simply overreact to those news. So they do not make any rational decisions also. So neither one nor the second statement is correct. Moving towards the last question that you have basis this case study, which of the following statements are correct? First statement says that the equity finance reserves represent cash which is available for the company to invest. Now guys, is it mandatory that reserves will always be in the form of cash? It's not mandatory. So the first statement cannot be correct. Second says that the earnings per share is an unsuitable way of assessing the financial performance against Gonzola company's competitors. Now, when you compare the earnings per share, a lot of factors can actually influence the earning per share because different companies may have different number of shares in issue. They may be of different scales in nature. So the PE ratio will be a much better way to compare them to the competitors. So the second statement is saying that it is unsuitable. That means the statement is correct. If you have a look at the third statement, this says that the scrip dividends decrease the liquidity of shares by retaining cash in the company. Rather, if you're issuing scrip dividends, that means you're giving shareholders bonuses, or you can say dividends, in the form of giving them extra shares in the company without taking any money from them. What happens is, because of this, there are more number of shares that get issued in the market. As a result, per share value falls down. That means this rather increases the liquidity rather than decreasing it. So only the second statement in this case is correct. First can be correct if it says that equity finance reserves does not represent cash. It can be in the form of any extra profits which were accumulated that may or may not be in the form of cash. And then scrip dividends, rather than decreasing, they increase the liquidity of the shares because there are more number of shares in the market which are available now. So with this, we have come to an end to all of the questions that was there in this mock pertaining to the Gonzola company. I'll see you people in the next video where we solve the last case study pertaining to the section B of your pre-December 2025 mock exam. I hope that these videos have been helpful to you and I wish you all the very best for your final exam.